Good evening, everyone. This is Chris Smith from the Option Club. Thank you very much for joining us this evening. I have with me tonight Dr. John Summa. Dr. Summa is a professor of economics. He is also the founder and managing member of OptionNerd.com. Tonight we are going to be talking about time spreads, which is a class of options trade that covers everything from the calendar spread to any form of diagonal spread you can imagine. Dr. Summa is going to share with us a few insights in terms of how he likes to use these types of spreads. And with that, I'm going to turn the reins over to him so that we can make good use of the hour that we have with him. And John, if you're there, you should now have control.
Okay, thank you very much, Chris, and welcome all. It's great to be back here doing a talk on options. And tonight, as Chris indicated, we will be looking at my favorite options strategy. We could call it generically time spreads, but specifically we're going to take a look inside that realm, the so-called time spread or calendar spread, and we're going to look at the diagonal version of those, which of time spreads is my favorite for reasons I hope to demonstrate to you tonight. Trying to reveal the hidden power of the time spread, particularly this diagonal spread, and really highlighting some of the movable parts that may not be apparent to you, and frankly in most trading books, options books, time spreads as well as the diagonal version of those are often underrepresented or underpresented. So I'm hoping to fill in some big holes in understanding of the time spread, and particularly tonight the diagonal spread. I will cover, to begin tonight, I will cover time spreads in general, and then what they are and why you might use them. And then we'll move to from the standard sort of textbook version to a more customized, nuanced look at time spreads in the form of diagonal spreads, which, as Chris has mentioned here, they can take on many forms, and that's really the art of these things, is finding the right customized form of the diagonal to fit a particular market condition. So let me see, just take a second here to make sure you're all seeing this cover slide, options time spreads, and my mouse pointer. Just want to make sure that is being shared. I did click to start the sharing, so
Everyone responding says they can see it and that the audio is very good.
Great. All right. Well, let's take a look here at the cover slide. I love my little colored balloons, kind of a diagram here at the center, options spreads. And, if we look around here, you're probably familiar with options enough, most of you. The variety that are common, kind of spreads you'll see out there. Probably the debit spread, most common, and then the credit spread, two general categories, really the reverse of one another. We'll look at some of those tonight. So that's probably the most common type of option spread. We're going to zero in on the time spread, also known as a calendar spread, not to confuse these things. There's a sort of calendar, time, interchangeable terms to describe this type of spread, which I'll get into the details of in a minute. The vertical spreads here really fall into the category of these credit, although credit can be extended to a time spread. Generally, a vertical spread you'll see as a credit or a debit spread. These other categories, E-mini option spreads, particular market where you can do these things, and allude to maybe the markets where we can apply these tonight. There are so-called delta neutral spreads. That's a very interesting area, the neutrality of one of the Greeks here, the delta neutrality. I'm going to try to reveal the use of delta inside the time spread and how we can play around with not just neutrality, but also a dynamic nature to these. We'll interrelate the delta dimension with the theta and dynamically relate them tonight. And then combos, of course, can be combinations of credit spreads, debit spreads. Usually your covered strangle would be a combination credit spread. I do seminars and webinars on those, but tonight I want to really draw your attention to the time spread and particularly the diagonals. So with that brief overview, let me see if I can get my my slide here to move into. Oops. Let me see if I can get to the. Having a little trouble getting my. Let me go with the pointer here to. I think I know what I've got to do here. This is needing to go to. Okay, there we go. All right, so let's run back. Sorry about the reverse run. Okay. So 3 groups of option spreads. Let's do an overview, beginning with the vertical spreads. The vertical spreads, as most of you probably know, take the form, as I said at the outset here, of a debit or a credit type. The key thing in terms of comparing them to the time spread is that they're using options with the same expiration dates. And vertical is referring to the use of the options chain in a particular month or week or quarter, depending on the kinds of options you're trading. They do use different strikes, hence a spread. It's not a single option, it's a combination of options. So we get a buying and a selling, or a selling and a buying. So we're using different strikes in the same options month. Moving now to horizontal spreads, note that we're going to actually, in the horizontal form at least, to begin, we're going to have different options expiration dates. So we actually reverse the above, from use of strike dates to different dates, and that's moving across time, front month, back month, which we'll talk about. 2 different months, 2 different expiration dates. But we're going to use, in the horizontal form of time spreads here, our first form, the horizontals, same option strikes. And that's the generic textbook calendar spread, which you find, everywhere, and often misrepresented for reasons I'll talk about tonight. I want to try to point out some of the hidden dimensions, which can be potentially explosive from a profit point of view, that hidden dimension. Or it can undermine the trade, depending on how things shake out. And that area, by the way, is in the area of volatility and the risk Greek called Vega. We'll want to take a look at that inside, not just the horizontal to begin tonight, but extending that analysis into our featured spread tonight, the diagonal spread. We want to carry some of the mechanisms in our horizontal spread over to diagonal spreads analysis to understand them better. Now, in terms of the general structure of the diagonal spread, because we can kind of fit these, particularly the legs we're going to use in them, to market conditions. So let's begin with just a general understanding of the times of the diagonal time spread. We're going to here, of course, use the different options expiration dates, hence a time spread. But we're going to change up another element here. Instead of same strikes, which were found in the horizontal, we're going to actually open it up to actually any number of strikes. Think about it, an option chain, if an option chain has 50 strikes in one month and 50 strikes in another, if you use the multiplication rule, you can, theoretically, come up with 50 times 50 or 2,500 possible combinations. So, I mean, there's really any number of ways to combine these things, at least in theory now and in practice, but would we really want to, and why would we want to combine strikes? That's the question I'm ultimately going to leave you with tonight, is when would you want to apply a diagonal, and how would you combine two strikes to form a diagonal? What market outlook and or technical condition that would fit best with? So let's move on. That's an introduction. I'm not going to spend any time on verticals tonight. It's worthy of its own discussion, but just to get ourselves in the spread space tonight, bear call spread, bull put spread. These are your standard credit spreads in a vertical form. Out of the monies are sold, of course, generally, and you're going further out of the money, FOTM. On the call side in this particular instance, to get a credit. Down below, selling it out of the money put, buying a further out of the money put generates a net credit. Exactly how wide those spreads are will define your risk and your potential profit. On the flip side of this credit spread, we have the vertical debit spread, our bull call spreads, and our bear put spreads. And these are buying strategies. We're not time value friendly here. We're buying an OTM and selling a further out of the money with a net debit, and that's going to have a negative theta. It's going to decay time premium across time. It's going to bleed away its value simply from the passage of time, whereas in our vertical credit spreads we would hypothetically gain from the passage of time, assuming no other changes. Bear put spread, the same thing. Here we're betting on the downside. Bull call spread betting on an upside move. It's a directional trade, and we are vertically structured and exposed to time value in a debit type spread. So we will also suffer from time value decay there. Out of the money put bought, further out of the money put sold to offset the outlay of money to buy the out of the money put. Net debit, and sort of a review there of your basic vertical structures. The vertical put spread in the credit form here is an example. Not really going to spend any time on this, but you can just see that a credit in this particular market using the S&P futures. It could be SPY options, it could be Priceline, it could be any market. The specs will be different. But we're going to generate a credit with a credit spread, and that credit will be of different magnitude depending on the market, the spread, and so forth. Here we've got a Feb 780 sold and a Feb 760 purchased, 20-point put spread, on the S&P minis. Where to place these? Why are we? I'm just using an example here to define a spread. This is arbitrary right now where these are selected. The risk, of course, is defined by the distance between the spread minus the credit collected up front. We can define a break even, taking that credit and subtracting it from the short leg 780 here, as you see, minus 275, which was collected from selling this, and put a break even at 777.25. We were actually at 845 here when this was priced out. The leg, sometimes I'll refer to a 10 delta, 20 delta, depending on the setup. It's referring to the short leg targeted. Here in this case, the 780 put had a 20 delta on it. That's the selection rule, one of my rules. And I'll refer to the 10 delta leg as a selection, sometimes the 20, here the 20, to select an option strike to sell in a spread structure. Now we're going to do this diagonally, so we'll move on to some of these will carry over. Our concepts will carry over to the diagonal world. Here's just generating a profit loss at expiration, here being the green, the white line being the T+0 here and now profit loss diagram, and the market being the S&P futures. And this particular vertical put spread, obviously exposed to a downside move that's quick, and it's going to be long delta. And we have a cap on losses, or a floor on losses, and a cap on profits. Pretty boring trade. It's got a terrible risk reward, in my opinion. Doesn't offer a whole lot of profit, explosive profit potential. So I use this sort of as an example of contrast with here as we move into time spreads, and particularly our feature tonight, the diagonal spread. The position structure, looking at horizontal time spreads, as we've defined them, same strike across time. They can go two ways. We can sell them or buy them. Okay, and let's start out with the position structure here, where we're going to sell the nearby, which is your kind of textbook version, by the back month. The point here being that you're going to find two options that are at the money, let's say. They can be out of the money. As long as they're the same strike, they're known as horizontal. But most of the time they're presented as at the money. So you're selling a front, buying a back. Let's say it's sequential months. Your back month will have much more risk from volatility. We're going to turn to that. That's one of the hidden dimensions, I think, overlooked a lot. So we're going to have to look hard at that buying back month from a volatility perspective. But what's often, sort of the feature of this is that you're actually getting decay slower. You're getting slower time value decay on that back month. And the aim here is to find a non-directional underlying, sort of trading in a range, and put a time spread on at the money, and hope that the nearby peels premium off faster with its bigger theta, more decay per day, and you profit from a differential in that decay rate, front and back month. Now, this is probably something you've looked at. Everybody has probably looked at one of these in a book, or even tried one of these in trading. They are debit trades. Interesting thing here about it is a buying trade. You pay for it, but you're actually dynamically kind of a net seller. So you're profiting from the faster decay on the front compared to the back, and you can potentially pull out a profit if volatility doesn't work against you. We'll turn to that in a bit. The debit is good because it defines your maximum risk. So it is a well-defined risk trade. You have maximum risk known at the outset, and the differential decay, well, that's not so easy to define a maximum profit for reasons we'll look at. Let's turn down here below and look at some of these risk dimensions. As we know, it's going to be a positive theta trade. You've got the decay happening here in the front month faster than the back month in this horizontal structure. That may not be the case in a diagonal, as you'll see. We can actually design it to be exactly what we'd like, and I'll do that with a couple of trades tonight. We'll move over to ThinkOrSwim, and we'll simulate a few of these ideas to finish out tonight, round out the evening with kind of a look at some real trades, some real prices, options, and so forth, and move away from these PowerPoints. Now, here is where most textbooks I've seen, and I have right here with me, I think it's the #1 selling options book of all time, all about options. I don't have it here in reach, but it's one of the most, I think it's probably sold more than any other for a beginner options book. And in there, you will find the calendar spread, the horizontal time spread. And yet there's not a single mention of Vega in terms of that trade. Now that's I mean, if that's not a breach of or a huge absence of financial fiduciary responsibility, that sort of thing, I don't know what is. This is a Vega trade, okay? This is not a theta trade. This is the way it's presented. It's really a Vega trade, okay? We'll see this in a second. The delta neutrality here, well, it's a narrow region of neutrality. We'll take a picture here in a second. It really doesn't, it has a dynamic neutrality nature to it. Can't really show you that right now. We will play around with these in a dynamic way in a little bit. So let's take a look at this. I mean, you've seen it before, the profit tent of a horizontal at-the-money calendar spread. Doesn't matter what market. This is S&P futures, could be S&P SPX, it could be OEX, it could be SPY, it could be Priceline, Netflix, what have you. It's going to look like this if you sell the at-the-money front month. Here in November, 1100 call on the S&P, and going long a December 1100 call. And I have the legs up here. This is using option view here, a picture from option view. This is an old one. So that relative neutrality in the T+0 plot here, there it is. I mean, this non-neutrality range over here is arguably sort of dynamically neutral, because as time decays, this will actually bend upward. So you'll get a wider range of neutrality. Of course, that doesn't mean you're going to make a profit. And there are other things that can move this P&L around besides time value decay. One particular oversight in most books, as I've already said, is the Vega dimension. This particular trade here, we'll see when it's reversed, will turn all of this on its head. But let's be sure we understand a few things first. Let's look down here at the Greeks. To the left bottom where my arrow is, move across. Here is Vega. Let's move across here. We'll see a 297.9 Vega on this trade. And I just want to take the extreme case because this is highlighting right now at expiration. So all the Greeks in here are actually pulled up for you by looking at the 24th day in this trade, calendar day, and that is actually expiration. So we're really looking at the expiration day for this front month 1100 call. So really what we're looking at is just a leftover long December call that's right at the money. But the problem here is that it's got the modeling of the other leg in it. But what it's doing is it's giving us, in effect, the at expiration Vega on the long remaining leg. Well, let's take a look at this, 297.9. Well, that in option view, by the way, is a dollar Vega term. And that means for every point higher in the VIX, this trade will gain $297.9 approximately. And every point lower in the VIX, our volatility index, and I use that as a rough measure of volatility for the S&P market, options in that market, it will lose $297.90. Let's just round that to $300. So essentially what we're saying is that for every rise in the VIX by 1 point, we get approximately here a $300 gain on this trade, other things remaining the same, ceteris paribus. If we get a 1 point drop in the VIX, we'll lose $300. Well, okay, so we lose $300. Let's turn back to the old common view of these, that is time value decay kind of trade, the neutral outlook. It's possible with differential decay at about 16 days into this trade with no other changes, we'd have about $800 on this trade in profit if we were, right in the area where we began this trade. As you move further away, the profit will drop to, say, $400 here, $400 here, about 20 handles higher, 20 handles lower. That's assuming no volatility change. And at any time in between expiration and the start of this trade, indicated here by these plots, we will have long Vega in here, but the long Vega will not be as large. So this number actually gets larger as we move across time toward expiration here at the pinnacle. Now, the problem with this is that if we're in this trade and volatility collapses or drops a couple of handles, the VIX goes from 20 to 18 to 17, or is high to begin with, which is where you'd really want to watch out, because this is a long Vega trade. VIX comes down by 3 or 4 handles, well, you know, you're going to just, if we hold this constant, it may, you know, just for the simplicity here, it could lose 300 to 1,500 points, you know, depending on how much collapse in volatility we get. So in effect, if the maximum time value trade profit on here is about 2,200, if we happen to end right here, you know, at expiration, 2,548 actually to be precise. We really are assuming this in this model with no change in volatility. If the volatility collapses, if we were to step into a trade like this in a relatively high volatility zone, and that volatility comes back or comes in real hard, basically what happens is this whole profit tent at expiration just gets pushed lower, and we can have this max profit actually below the break even. Now that's an extreme case, but in other words, we've got a classic textbook calendar spread here we're looking at, and rarely is, I mean, there are some good books that explore this, but rarely is this exposed to the new trader who waltzes along thinking, wow, you know, I can profit from time value decay, not, you know, with, you know, sort of not at all aware that if volatility comes down, you know, so go the potential profits. It can be very fast. Volatility change can wipe out any potential profit in this very quickly. So that's the bad news. The good news, the volatility could go the right way. The volatility could go up. Now you're supercharging this thing. You're supercharging it with the volatility moving in the right direction. And while we could talk about some contradictions in that, you can clearly see that this thing would pick up some enormous gains from a punch-up or blowing out of volatility. Spike in the VIX, you know, I think would clearly, you would really see the move higher. And essentially, the whole profit tent moves higher. So the current static, non-dynamic look at this trade puts break-even, you know, just around 1130 here, 1073.90 on the downside and 1130 on the upside. It's not very far away from the 1100 start point. Should volatility move higher in the intervening time of 24 calendar days, this entire profit tent moves higher, and essentially the break-even points move lower as that tent cuts further and further down the price line. All right, so you'll see a volatility move bring this at expiration P&L from, say, minus 1200 to break even, and the entire tent has moved up. So hidden inside of a time spread, here we're just beginning with the horizontal. We're going to extend this analysis into the diagonal realm, where it gets really interesting. But to begin to understand these things, we need to reveal first the hidden Vega dimension, which can either supercharge one of these things, these time spreads, or it can implode them. You know, lurking in the background can demolish essentially the textbook story of a differential time value decay spread. All right, so that introduces the idea of a time spread and the revealing of the hidden Vega dimension, which is really powerful. So let's take a quick look here at reversing these, selling the back, buying the nearby or front month, and here we have a credit, but of course it's not net theta positive, it's net theta negative. It's going to lose money from time value decay. It's reversed its theta, therefore, to a negative theta, and we have a reversal of our Greeks here. Now we're short our Vega. We're negative. We're not long or positive Vega as we saw in the previous case. That narrow delta neutrality is still in there, of course, where we can begin here. That's that little space of near neutrality, but that again is going to be pushed around with time value decay and with Vega, with volatility changes. So the 10's been flipped over here. As you can see, we're reversing everything. So the 10 peak here is now flipped down. Everything is remaining the same, exact same strikes, but just reversed in order, buying the front, selling the back. And, you know, you're giving yourself now a negative Vega. Now, why isn't that still 297.9 as we had here, 297.9? It's because I've actually highlighted this time around, just 8 days into the trade, I've highlighted the second P&L here, sort of 8 days look at it. So it's moving toward that number of 297.90, but it's going to be moving that way in the negative. So we're about halfway there here, 8 days in. It's moved to negative roughly 146 Vegas. Those are dollar Vegas, okay? Dollar Vegas. For every point now we get moved higher in the VIX, we're going to actually experience a decline in the profit, other things remaining the same, the unrealized profit on this trade. So this is known as a short Vega trade, meaning that it will lose money from a rise in volatility, just like you would be short a stock. If it moves higher, you lose, or short futures, you lose money. Here, you're short Vega, meaning if the volatility goes higher, you lose, other things remaining the same. I mean, assuming no change elsewhere, you will lose on this trade. So short Vega on the reverse calendar, here horizontal. But also, we're suffering from time value decay, okay, unlike our non-reverse version of this. So should time decay, and we don't move anywhere, we're going to be down already almost, you know, $300 approximately here. Actually, 300 as indicated here. But if there's a move in volatility, this number could be worse. The volatility moves higher, we're going to knock more value off this spread. Excuse me. And if on the other hand, if the volatility moves lower, if the volatility moves lower, and a little volatility in my slides there, it's going to add or counteract the time value decay. So you get the story emerging here, the interaction of the Greeks, theta against Vega, and then we can work in delta and how delta contends with theta, conforms with Vega, or does not conform with Vega. So we'll see we can begin to look at movable parts inside here, delta, Vega, theta, and see how at times they'll conflict and at times conform. The trick is to not let all the Greeks gang up on you. And if you can avoid the gang up effect in a spread like this, and turn that around and have them all on your side, so that you're the gang and ganging up on the other side of the market, then you're going to be in good shape. So one of the things I try to show you with the diagonals is that you can customize these to try to get the Greeks to all be allied with you instead of contending with you, or one or two contending with each other and therefore sort of fighting with each other and therefore undermining the maximum potential of the trade. So that's where we're going. We can take these to finish out the horizontal version, and I believe we're doing good for time. I want to leave at least. We got started a little late tonight. I want to leave at least 15, 20 minutes to do these diagonals. So anyway, we'll make this part short, the horizontal, and we'll move right into the diagonals. The horizontal is really the same story we've seen here in the form of an out of the money, and this one a bullish one, and then we can go to a bearish out of the money horizontal. And essentially, we're just taking that same strike structure here, sell the front, buy the back, and we're just moving that out of the money here on the put side, here on the call side. I don't have time tonight to tease out all of the implications here with out of the money horizontals, whether they're bullish or bearish. That'll have to wait to another night. But we're kind of, this is almost a midwife to the diagonal structure, because the diagonals actually use out of the money options, so we're almost there, but they relax the assumption of same strikes across time. So then you see we get almost there here. So it's more of a we're almost there picture. Anyway, out of the money put or out of the money call strikes, but they are in the horizontal form here using the same strikes. So let's move on to the diagonal structure, and then I'll try to use remaining time to set up one of these on the SPY options or price line. We'll pick an underlying and apply something here from what we've learned. So position structure, these, as you know, are going to be using different months, but it's more complicated than that. As you'll see here in this call side version, you can do a credit, and that's where we'll start tonight, a credit diagonal call spread, and it can be a credit diagonal put spread. So if we look back here, the position structure on the call side would be selling a nearby call option. So it's out of the money, but it's nearby in the sense that it's the nearer month, and then we're buying a back month option. Now that option, well, back month, can be nearer to the month in the front strike, or it can be farther out. That's up to you, and again, that gets into strategy, design, and application, and where you want to go with that. It's not the subject of tonight's talk, but so selling the front, buying. Well, there's any number of strikes. There's a lot of different strikes that would work depending on your outlook. You can create a debit, a credit, or you can do even pricing. There's that flexibility in here to combine the back month with the front month, and even decide where the front month is going to be to begin with. But when you combine that back month, it can be structured debit, credit, or even money. Now that's just looking at the pricing structure. There's also, well, we won't go into it too much tonight. I do in my DVD on supercharging with diagonal spreads that I have offered for you guys, the club members, where you can combine Greeks in a specific way. So we can combine the deltas on the options front and back. We can combine the Vegas. We can combine the thetas. And we want to get in there and combine those in a way that's going to conform to our market outlook. And that's where you really unlock the power of these diagonals to do things that other spreads just simply don't have the capacity to do, because they're not combining different months and all of that hidden power that's, I think, in options trading, it actually pulls together all of the beauty of options, and you can't get them in most other types of spreads. Time actually brings in a wonderful world of customization here in the diagonal structure. Okay, that's why I have question marks here after all of these. What are the risk dimensions? Well, you're going to design the risk dimension. That's what I show you how to do. You're going to design exactly the theta risk, if any. You might want to be positive. You might want to be negative. You're going to design your delta. You're going to design your Vega. And there are some ways to do these diagonals that are ideal, in my opinion. I mean, there's a way to get these on in a particular market, technical picture, and really supercharge the potential for profit relative to risk, and also have a follow-up, sort of repair capacity in it as well. I mean, you can come in tactically and do some repairs on the market, given the market move, to defend these positions or to tweak them to continue to accommodate that market move. So that's the repair story, which we obviously won't have time to get into tonight. So that's the call side picture of a diagonal. For reasons, for sake of time, I can't go into all of the problems on the equity side with call diagonal spreads because it's complicated. But essentially, there are inherently aspects to the market that are dynamic that don't work right with diagonal call spreads. Now, that's not true with all commodities markets. So there's a place for the use of the call time diagonally structured, but not on equities. Equities, I just use it here as a stylized presentation. The put side is really where you want to go in the equities. That's where all the action is. That's where these options, you can keep the Greeks from ganging up on you. It's really in a sort of first thinking about where to put these and how to do it is that put time spreads diagonally structured are going to be used on equities, and that's where you want to think about doing these. Now, there are different ways to do them on that market. So anyway, selling the front you'll be doing, and you'll be buying the back. There's different strikes, how far down you go, how far away from the front month will set up a debit, credit, even money, even pricing structure. Your Greeks will be customizable related to what you're doing over here in terms of the pricing. All of it sort of comes together when we look at one of these things, and we'll do that over here at ThinkOrSwim in a second to finish out this evening. Here is a static look at a T+0 time frame in option view, and this is an entry point right here. Diagonal put spread on the S&P, selling a 1050 November front month, going down 50 handles, buying a back month, December 1000. So we've got a 50-point spread front and back, and this is what it looks like. It's got a pretty decent, just straight away within a certain range, 40 handles or so up, 50 handles. You've got some time value decay potential value. It's a credit. You're taking in a credit. It's not easy to eyeball this because I've got the zero time elapse, so it's not really giving you anything here. But you can see that credit is going to remain in this trade no matter how far up you go. So you'll take 200, 300, 400, I don't know the exact number here, out of this trade on the upside, depending on how far up you go. That's actually the sort of the minimum, for like a vertical put spread, credit spread. You collect that credit, and that's the end of the story. But on the downside, you get this profit tent, and this is static. It's going to move higher with volatility changes. What you'll see is that on the downside moves by the underlying this way, lower, drive volatility higher, as you know, and this whole profit tent just lifts off. Okay, so it essentially moves this break even lower and lower. Now this one is a particularly sort of stock trade. It's a put time credit spread. It doesn't have to be done like this. In fact, you can remove most of the downside risk, if not all of it, and still have an enormous supercharged profit tent in here, which can be dynamically illustrated. I can't go into all of my setups here. That's in the DVD, but basically I'm revealing all of the mechanisms and the movable parts that go into that story. So that's the static look. That's the stylized look at these types of spreads, the time spread, and here tonight the featured trade, the diagonal, and actually of those diagonal structures, we're looking at the diagonal put spread, we saw the credit version of that, and on equities, S&P, but again, it could be across any number of equity markets. So that's the static look. Let me just take a second here, and I'm going to switch over to ThinkOrSwim, and I just want to make sure you're able to see this. I'm going to widen up that P&L window, our risk profile, and I've got a similar looking trade right here set up, as you can see on the SPY. Using the SPY tonight just simulates a little easier in after hours. And down below here, let me just show you the legs. You know, I did a 10 delta selection here to sell the front, and the front here is January. All right, the month of December we're in. Typically, you know, as you're moving into the first, second week of the month, you know, I'm looking at the next month as the sell month, and then the back month being the February, you know, month. So it can go on month after month, and you can set these up. But you might want to customize them according to where the market is and where it's likely to go, which is what I fully explore in the balanced and unbalanced DVD Supercharger trading with the diagonal spreads that we've got for club offer, plus a whole bunch of bonus items in there. So do take a look at that. But this profit tent we just saw in the static slides can be made dynamic here, and I want to just show you what that means, and kind of begin to pierce, you know, the veil over these things that most of these boilerplate textbooks or boilerplate, you know, beginners, how-to, idiot's guide, you know, all those out there, all about options books, you know, they don't reveal. You know, I want to pierce the veil of this trade, the time spread, and get at some of the movable parts. All right, so if you have ThinkOrSwim, you know there's that little wrench down here, which I love, and you just click on that, or you click it back on, and you get all these little simulating tools. Okay. Our yield, which we won't mess with, it doesn't really apply here, but we can do the volatility adjustments, and we can adjust the stock price, and we can adjust the date. So we can really have some fun here simulating any trade. So this particular trade, let's look at what we got here. So we sold the 132. We're trading at 143.72. That is a 10 delta, approximately 10 delta strike. That's why I chose it here. It could be, you know, there are other approaches, but just so we're on the same page, the back month is just moving down 10 handles, okay, and to just simplify things. And we're generating a small credit. So if we just shoot up here, you can see that that credit, looking to the left of that risk profile in red on January 19th, which is the expiration of the front month, this will, if it just move, we just move higher, we'll have $120 in profit there. That's the credit. That's the minimum profit. So that's sort of the, you know, the uninteresting part about this strategy. The interesting part about this strategy is looking on the other side. Okay, if we move lower on the S&P, or the equity markets move lower, or stock, whichever you're trading, and looking at our entry point right here, you know, there's going to be a stretch, statically speaking, just where we move down the price scale, you know, where you're going to see some losses on that white P&L, the negative 684 statically here. But of course, if we just were to stop moving lower and time decay, we would still have profit. Note the greater profit though than our minimum profit, minimum 120. Here we're at 280. So, you know, this is the risk management problem. You know, when you do move down here, if you are showing an unrealized loss of 817, it's like, hey, you know, well, I'm still good at expiration down here, and that gap gets wider and wider, and that's when you start sweating bullets and holding on to that steering wheel, white knuckling. if you're going to approach it that way. There are ways to adjust these trades. And of course, break even being down here at about 130, 132, statically looking here. We're gonna make some changes in a second. Unrealized here about just shy of 2,000. If we were to expire about here, we have about 560, maximum profit. Looks like we hit around 565. So 3 to 1, more than actually. At that point, you're looking at about a little more than return to risk of 1 to 3, right around in here. A little bit worse than that, but let's dynamically dynamicize. Let's make dynamic this trade. Let's turn over here to our little simulators. If you are moving down 10 handles on the S&P, let's just say about 1,100. I'm sorry, about 100, 110, 120 points. That's going to blow out the VIX from its current levels to, it's nonlinear, but let's just say for every 10 handles lower, we get a point in the VIX. I think that's conservative, and we can put that in here and simulate that. So right away, we move the profit potential at that point up, should we expire around in here, to over $1,400. Okay, so not quite tripling, but we also move break even lower. Now this is just moving the volatility higher to reflect the drop down in here. That's assuming we drop today. Well, if we drop, at some point into the trade, let's just say a couple of weeks in on the 26th, that's going to also play into the degree of profit, but not at expiration. It's going to be what's on the P&L currently. Now, let's just back off by days. You can see that P&L will move lower and lower, reflecting the reverse of time. But if we let time elapse, moving forward in the middle of and toward the end of December, we see time is coming in to help here and pushes us positive, and bingo, if we expire anywhere in here, we come out with a pretty decent profit. But that's still nothing in terms of the supercharge that you can do to a diagonal here. And more than that, you can take that downside break-even point and make that dynamic as well, so that it actually stays ahead of the market. So market moves lower, and you can balance these in ways that balance the Greeks in ways that will keep that downside risk ballooning in your favor as the break-even point is pushed ahead of the underlying, essentially almost removing the downside risk. You can't fully eliminate it, but you can take it out of there, and this is again assuming no adjustments whatsoever, and almost sideline it. This is just a first look here to try to give some feel for these things in motion. All right, in motion, these things look much more interesting. Now, we could get into the subject of margin. There's Reg D, there's PM, there's different margin on the equity side. On the future side, you have span margin. Obviously, span margin is the preferred, but with the history, recent history in the futures clearing firms, shenanigans, nobody has any confidence to be in futures because of the shady nature of the so-called segregated funds being used by FCMs for speculative purposes, misappropriating funds. Equity side's more safe, at least so far, and has a different structure in terms of how those counts are made secure. I won't go into a discussion about that tonight, but the margin system on the equity side can affect these diagonals in adverse ways. If you're using the old Reg D, you're going to get fully margined on the spread between the strikes. If you're using PM, you're going to have a span type margin, which is very small. So you can drop your margin down on these things considerably. And the Reg D margin can go up. I have here 98, 100. It can be PM margin down considerably. We can talk about that if anybody has any questions. But truly, the diagonal on the equity futures market has the best margin power, I think. Portfolio margin on the equity side is fine. You get some really great leverage. And not, proportional to risk. Just because you're given more margin doesn't mean you're taking on more risk. It just means that you're needing to post less capital as margin to do the same trade. The old Reg D margin is pretty outdated. It's still applied, unfortunately, to most retail traders. So we could spend, as I do in my DVD, several hours taking apart this basic idea here of the dynamic nature of the diagonal spread here on the put side on the SPY, and we can customize the design of that to fit market outcomes. Market outlooks. Market outlooks really are the final shoe here. We want to be able to apply a diagonal spread to particular market condition. And I think it doesn't take too much thinking to figure out where I'm going here. If you can line up a reliable technical condition with the proper customized version of these diagonal put spreads particularly, you can really get the maximum punch out of the strategy. And you can do it when you combine repairs and adjustments at the end in a way that essentially sidelines the major risk problems. There's always risk. The problem that traders face is having no sense of the risk and the magnitude of it. And second, when there is too much risk, how to trim that risk and still stay with the trade. That's the difference between novice traders and experienced veteran traders, is knowing their limits and knowing how to adjust and repair strategies to trim the risk and retain the trade and some potential for profits. So, Chris, I'm gonna stop it there. We are coming up on just past the top of the hour. I didn't want to use up more than my allotted time. I don't know what schedule you have, and if you want to come in with any questions or field some questions, I'm happy to answer questions.
Yeah, why don't we take about 15 minutes and answer any questions that are out there. And there's already a few on the screen, but if you want to go ahead and type some into the question box,
yeah,
we'll go through and field them. Let's see. Michael's asking, would you use a reverse? I think we're talking about a short calendar is my assumption here. Would you use a reverse right after earnings as IV gets crushed?
Okay, yeah, that's a great question, and it's one that we have in many of the seminars I've done. When we get into the diagonals and we get into calendars, of course, that's a really interesting area to think through. Not only in the way you asked the question, like after the crush, but before, going into the earnings as expectations are mounting. Sometimes you'll see them with these tech stocks. You'll see some of the volatility, implied volatility. The market itself may calm down, but the statistical volatility may quiet down, but the implied volatility begins to blow out higher, and so either before or after, there's the potential, if you kind of think of the volatility as reversion to the mean, one way or the other, depending on where we are away from the mean, you can apply time spreads in a reverse way, to fit that, volatility being too high. Reverse is going to give you the short Vega, and then a standard, straight, sell front, buy back, you're going to be long Vega. So, you'd want to get long Vega as we're going into the season for rising implied volatility, and then hopefully capitalize on the collapse. Now, I think your question was after the collapse, the volatility. So now the question becomes, do you ride it higher again, into the next earnings season? I think that's where you were headed, to try to ride that cycle of volatility. You'd have to look at the particular stock, know the stock well, know what's going on, anxiety, in the market over, like Netflix went through a lot of gyrations there. We had some Priceline, maybe back a few months. Those kinds of stocks get keyed up, so you can adapt, the calendars to those conditions and try to capture the move in the volatility. However, that said, we have to be careful, because there is a delta and a theta dimension in these trades, as you saw. So the timing of when you do these, is important. Not only because you want to be timing the volatility crush or explosion, but you want to be timed right. But you also want to make sure that time is not working against you from the theta dimension. If you reverse, you're going to be negative theta, and you're going to be bleeding away, time value as each day ticks by, as you're waiting for the volatility to move in the way you'd like it. So, that's a long way of saying it is possible to trade either way. The volatility coming into earnings, post earnings, if there's that kind of crush. So there's really sort of three areas. You can try to ride the volatility into the earnings, try to get positioned near the top there, right before earnings, the other way, in hopes of a collapse, which typically there is, and then maybe reverse once more to go the opposite direction, to ride the volatility higher into the next earnings season. I hope that answers your question. We don't have the time to explore that here, but certainly that may be another DVD I can derive from these time spreads, or actually explore the application in 6 or 7 case studies to illustrate how this would play out, and the proper application of these strategies to those market conditions that you pointed to.
We have a question here about whether you do any of these calendar or diagonal spreads using weekly options.
Yeah, I get that question all the time. The weeklies, frankly, I just have not, aside from helping some one-on-one mentoring kind of traders to work on a strategy they had in mind and try to help them through that, I do not do the weeklies. So, it's possible to combine a weekly with a monthly, and there's different ways to do that. But there's different approaches to that with covered strangles that are diagonalized, and there's just, there's a number of ways I've seen these things done, but myself, no, I don't do the weeklies. That's one market I did explore a while ago, but for a couple of reasons, I just felt it didn't fit what I was trying to do.
Can you mention one or two good books on time spreads?
Yeah, I would go to Larry McMillan's kind of the options traders encyclopedia of strategies. He's got I'm trying to remember the title of it. It's kind of the cookbook of option strategies. It's got everything.
Yeah, I think it's Options as a Strategic Investment.
That's it. And I don't know if he's in his 5th edition or 6th edition now. I have a 4th edition, I think, here.
Yeah, I think a new one just came out.
Yeah, I mean that's got a good deal of the stuff we're talking about in it, and then there's Nathan Berg's book, Options, Volatility, and Pricing. I believe that's also, both of these are at my website. If you go to you can get into the Learning Center there. There's a link to my options bookshelf. And my featured books are there that I like. So of course mine are there, but these guys really cover it all, and the volatility and the Vega story is really laid out well in Nathan Berg's book. It's a classic, that book really reveals that time spreads are not time spreads. They're really, differential time value decay spreads. They're really volatility trades, and that's all about options. I can't remember the author's name, but it's come out now, and it's sold millions of copies. I use it to demonstrate in my seminars that nobody's been teaching traders this, so there's nothing in there about Vega and time spreads. In fact, there's hardly anything in the book about Vega and options trading whatsoever. Just the whole subject of Vega is almost ignored in the entire book. So a beginner option doesn't know, there's a lurking menace to you. Whether you're just a straight call buyer or put seller, or it's lurking there. It can either blow you up, or it can supercharge your profits, either depending if you get it right. So that's my answer for that.
Yeah, we've got a couple questions, and I'm not sure how deep you want to get into this, but they want to know about adjusting the diagonal with a downside market move.
Okay, so a put spread in a downside market move, again, different ones that you can do. There's a lot of ways to balance and unbalance these things. You can balance them from the point of view of the Greeks. You can unbalance them from the point of view of the Greeks. As far as defending those and repairs and adjustments, the general approach is always to keep an eye on the value of the spread. Obviously, you can't ignore the value of the spread. So if you sell it if it's a credit spread and you collect $500, and that spread's blown out to 1,000, so now you've got unrealized losses on the trade, and essentially equal to what you'd make on the trade. That's generally a guideline to try to trim the risk. You don't want that to blow out much more than that. Of course, it's easier to say than do, but you got to have some sort of defense line to keep in line the risk on the trade. And at that point, you would want to adjust the trade. Now, how to adjust it? Well, there's a lot of different ways to adjust them. The simplest way is to purchase that short leg and sell it again lower in the front month. Now, what that means is you're going to incur a loss, but you're going to collect premium again. So if you do it the right way, you can keep that first adjustment if it expires out of the money. The rolled short leg, you can keep that to a scratch trade should the market stabilize and move sideways, even a little lower, move higher. Now, the long leg is another story, because here you've rolled the short leg lower and you've narrowed the distance between the short and the long, so you've reduced your risk. The long leg may pick up some extra profit depending on how far the market has moved lower, how much volatility has increased, and what time it is to expiration. So you may actually see that you're able to liquidate the long leg going into expiration week, and the short leg close out and have a profit on it, even though you've adjusted it once. Sort of giving you a general familiar story here. You can roll twice. Typically, when you roll twice, buy back at double the premium, sell it short again at equal the initial premium, so you kind of keep it all in perspective. Again, this won't happen precisely. It's sort of loosely doing this. Second adjustment, typically your long leg is really picking up some premium on the vol and the volatility and blowing out and the move lower. So it's possible to just roll right out of the trade sometimes at that point, or a couple of days in past that roll, and just say, okay, I defended, I'm out. Market's made an outside move this month, don't need to hang in there. On the other hand, you may actually allow this thing to go into expiration of the front month and see a really large profit on the back month, and the front month can be closed out at a small loss and unrealized, turning into a realized. You close it out, but I mean the thing is, or you could realize a gain on that roll leg, but you've rolled up a loss already, but you net out a full profit on all of it. So there's no simple answer, but those are general patterns that you'll get into in the thinking that you'll be doing in an adjustment plan that involves defending a move lower in a diagonal put spread. You can't just say if this, do that, and make it a hard and fast rule, except for saying you need to defend the trade at certain intervals, whether you use the prices, the spread value, the deltas. You have to have some guideline that's objective to follow and say, okay, I need to take down the risk, adjust the risk, minimize the risk, but stay with the trade. Staying with the trade is where you're going to have the potential to produce those supercharged gains coming out of that back month. It's really the back month that has the staying power for this trade. It can produce some enormous gains due to the rise in volatility and the fact that it is a back month. It has more Vega positive in it, and it can just trap all that volatility, and you're long the vol, so you get the benefit of that. And if you've defended your front leg, you're able to manage the risk and keep it from blowing out on you. And that's sort of the name of the game in this trading. Now, if you balance these right, you don't really have to do any adjustments. They can be made more robust, and that's kind of where I show you in this DVD to apply these in a more customized form to a market condition. And when you do that per some of these setups that I lay out, you actually have that downside story still there in terms of the back month being wonderful for making supercharged profits in a downside move. But you also have a dynamic story that's much more interesting where you can get the trade to sort of self-adjust. That's kind of my little secret. You can get this set up right initially so that it nearly always self-adjusts for you on the downside. Self-adjusting diagonal put spread on the downside. Now you pay for that, though. You're going to have to, no free lunch here. You still have to take on some countervailing risk or potential risk, but it's much more manageable risk, which is the interesting part of this than it might be in an out-of-control downside market environment. So looking back here, we can create this downside story that's more of a self-adjusting. I showed you a little bit of the self-adjusting, but we can make that much more interesting and create an auto-adjusting downside diagonal. So that's sort of my supercharged version of the diagonal that fits with particular market conditions that appear all the time, and they're markets regularly, depending on where you are and what market, but will typically set up on a pretty frequent basis to apply this supercharged version of the diagonal. So I'll leave it there with that. That's a whole, I've taught day-long seminars on that question. That's a really interesting area. And I have a DVD just on diagonal adjustments, but it's part of another adjustment area for condors. So that's my Option Pro Strategies and Repair Tactics DVD, which in the club offer I didn't include that, but hell, I could throw that in too. That's a DVD that's very popular. I sell a lot of those, and it's packaged in its own terms with its with a free webinar, 2-hour webinar from me live. So I could throw that in with the offer that I think Chris might have the link to working. I hope that's working now. We tried to get that earlier, but that's my answer there.
Okay. We've got a lot more questions, but I think we're going to kind of cut it off. We've gone over, and it's getting kind of late. But you've already mentioned that you've got an offer for everybody who's attended. And just to let everyone know, before the presentation, Dr. Summa provided me with an HTML link that he tested and found to be working just fine. But for some reason, I'm not able to pull up the web page. What I'm going to do is I'm going to post the link in the chat box right now. And if people are able to access it, good for you, I suppose. I still haven't been able to.
Yeah, it would be good to know if anybody else has trouble with that link.
Yeah. But what I'm going to do is I've recorded the presentation, and as soon as it's done processing, it's going to go up onto one of our web pages. And on that web page, I've been making some notes about a couple of the books that were mentioned. I'm going to have links to those books. I'm going to have a link to the special offer page for the DVDs that Dr. Summa mentioned. And you will also have the ability to watch this presentation again as often as you care to watch it. Okay, I'm getting messages. Chuck says it works. Shane says it works. KB says it works. John Dory says it works. Gianni says it works.
Okay.
Ray says it works. So I'm the only one who can't access it. I'm going to even try it again, but I just tried it a moment ago, and so I probably have some issue going on with my my internet provider. That there's probably some kind of a outage somewhere along the route. Yeah, it's not coming up for me right now. So
Yeah,
it's
but
just
you're
me.
online. You're online. That's interesting. Well, let me just thank you, Chris, before we adjourn here, and thanks again for hosting this wonderful club you've got. And I I know I've been here a few times and been out to the West Coast there. I think once or twice to join up with you. So, thanks for inviting me, and I hope your members found this some value added here to their trading. And do check out optionsnerd.com. I'm going through a redesign of that site after many, many years, migrating over to my WordPress blog type trading site. So got some good stuff ready for 2013, and looking forward to that. Possibly rolling out a newsletter as well with it.
You and I are both going through site upgrades, and I know it's no easy transition. A couple people wanted to.
It's not a fun thing.
No, it's not. A couple people wanted to confirm that the offer page that was referenced will include the repair tactics.
Yeah, it's not up there. I thought of that as we got into this, and I realized, maybe that would be a good fit here as one of the bonus DVDs. So I could swap out I had 2 bonus DVDs in there. I could swap one out and put this one in, Okay. So that could be included instead of one of the 2 mentioned there. I believe I forget if I mentioned the names of both of them, but I could put this in. It's not there now, so yes, I can confirm that can be part of the offer.
And how long will this offer page be up?
The offer page will remain up. That particular offer page is at optionsnerd.com. It's not available yet at optionsnerd.com. I customized that for the club members. It's kind of a little extra special. There's quite a few things thrown in there, more than I usually do. So, but I'll probably have that modified, in a couple of weeks. I'll probably. I've got a whole bunch of things changing. That's why I'm hesitating here. I'm not sure what it's going to look like going into the end of the year. I'm rolling out a new look and a new design, and that's still not clear. So the offer will be there in some form, but that price is reduced, and it will be at a higher price for probably through the end of the year, let's just say.
Okay. Well, that's I think that's a wrap. At least for this evening, and it looks like some people are saying they were successful in their purchase. I see that Bill Burton, he's having the same trouble I'm having, so apparently there's some kind of glitch somewhere out there in the ether.
Well, let me just let anybody out there, everybody out there know that if there is a problem, you can always just shoot me an email, and I'd be happy to optionsnerd@hotmail.com or info@optionsnerd.com, either one. They both get you to me, and let me know you're having trouble, and I'll send you a link directly, and we can talk by phone. We can have the order taken by phone. We can manage it for you one way or another, but I've had the link to PayPal occasionally will go down. I'm not sure why, but typically it works. I'm testing it all the time, so it works from my iPhone. It works from a BlackBerry. I've checked on, so it's mobile friendly. I don't know what's going on with the West Coast there, but you're online right now, so not sure why it doesn't work to my site.
Yeah, my internet's up, so my service provider's functioning. Obviously your website's functioning. There's just probably some traffic issue or some
conflicts.
obstacle at some point along the way, and
Yeah.
hopefully it'll clear up.
Try it later. Refresh your browser. Maybe maybe it's got some conflicts in there with the pages or something. I'm not really sure why that would be not resolving for you.
Yeah.
Anyway, again, yeah. So if you want to close with anything,
the email you provided was optionsnerd@hotmail.com.
Yeah, I put it in the chat window, and I also put in info@optionsnerd.com. That will also get an email to me, and that comes in directly here. So I can find questions, follow up, anything, just let me know, and I will do my best to get you what you're looking for. I didn't mention it tonight, but I do have an actual tour dates set up for some small mini camps, West Coast, Singapore, London, in the new year. So if anybody's interested in that, I've got an LA seminar, 2-day seminar, mini camp, January 4th and 5th, I think it is. I have to just double check that, Friday, Saturday, out in the St. Joseph's College, beautiful campus. I think it's St. Joseph's College in it's West LA area. Got a nice high-tech conference room, and I'll be out there. And probably have a small group. You don't usually allow more than 10. It's for highly interactive. So that's not available on the website yet. So if you're interested in that, let me know, and I'll shoot you some information about that. And those dates and all are going to be at the website soon. Just been marketing it directly to my members, who I know may have an interest at this point.
Well, with that, we're going to call it a night. And again, thank you for joining us and spending some time with us. And I'm sure everyone who has questions will be following up with you by email. But in the meantime, I'll get this video posted, and we'll send out an email once it's available.
Okay, Chris. Thanks again, and thanks all for attending tonight. And, best of luck with your trading plan.
Good night, everyone.